As part of the procurement team, the buyer, Katerina, often has to negotiate contracts. Once she's done that, the contract should be reviewed and approved in accordance with Kraft Heinz global policies, and then it will become active in the system. Once the contract is approved, the teams at the factory will be able to create purchase orders for raw or packaging materials to meet production demands. Purchase orders use the contract price that procurement has negotiated with the suppliers as the purchase order price. They have no immediate impact on the balance sheet. Once the ordered goods arrive on site, the local factory team checks the quantity and scans them, registering that the goods have been received. This is the goods receipt. The goods receipt is provisioned in the balance sheet as a liability at the purchase order price against the physical inventory, which is registered in the balance sheet as an asset. In this example, the goods receipt creates a credit of €100 in the liability and the inventory a debit of €100 in the assets. Therefore, assets equal liabilities plus equity. The goods receipt is a temporary position representing an obligation for payment to a supplier corresponding to a particular order. Next, Katerina checks if the invoices for the goods have been correctly received. Once that happens, they're booked against the goods receipt. The invoice posting is registered as a credit to the liability column as accounts payable, or AP, against the goods receipt provision, which is then cleared up. Finally, at payment stage, Katerina will make sure that the payment to the supplier has been made. In accounting terms, this means that cash will be deducted from the company's assets and the accounts payable position will be cleared up. So the cash is credited from the assets against a debit on the accounts payable. This last transaction clears up the accounts payable position.